Hi everyone, and welcome to our next lesson on product planning. And so in this lesson, we're going to be talking about sales and inventory management. So our objective is to be able to analyze inventory reports and sales reports to identify trends and make informed decisions for improving inventory management practices. So let's get started again with some definitions real quick. So inventory, this is the tangible assets or goods held by a business for the purpose of sale, production, or distribution. Now, inventory management is the process of tracking, ordering, and maintaining the availability of ingredients, supplies, and products. So when we talk about managing inventory, there are some basic ways to manage inventory. We're going to talk about three in this lesson. We're going to talk about regular stock monitoring, setting par levels, and something called the FIFO system. So let's get into each one of those. So in regular stock monitoring, this is the ongoing process of tracking and evaluating inventory levels, movements, and related data to ensure efficient inventory management. Next is setting par levels. Okay, this is where you establish a predetermined quantity of inventory that a business aims to maintain on hand at all times. And it is used to ensure that there is an adequate supply of items to meet the demand while avoiding excess stock levels. Typically, what determines your par levels are factors such as historical sales data, lead time for replenishment, and desired service levels. All right, so now the next one is FIFO systems. FIFO stands for first in, first out. This is a method used in inventory management as well as accounting. And so this determines the order in which the inventory items are sold or used. Basically, the idea is the first items that enter the inventory are assumed to be the first ones to be sold or consumed. And you can kind of see from this little example right here, the supermarket and the milk going in and out, stock the oldest, the newest, the oldest goes out first, hence FIFO. All right, so some other concepts and key terms when we're talking about sales and inventory management. And so there's a thing called lead time. This is the amount of time it takes a manufacturer to provide a product order. It is usually agreed upon during any contracting negotiations from that manufacturer. Receives. This is the amount of a product that has been inspected and verified from shipping into a warehouse or into your area of storage, whatever your inventory is. A purchase order. This is a document given to a seller from a buyer with specific purchase details, given to a seller from a buyer with specific purchase details of goods and services. This includes prices, quantities, and delivery dates. Warehouse overflow. This is a situation in which the available storage capacity of a warehouse or a storage area is exceeded. So you've got an overflow, you've got more than you've got room for. This leads to a surplus of inventory that cannot be accommodated within the space that you have. Okay, sales reports. Now let's get into, and all those had to do with inventory. So sales reports. Okay, sales reports provide valuable insight into a company's performance. They help identify trends, measure revenue, and help make informed business decisions. A report or analysis it is a report or analysis that provides details and observations regarding a company's sales during a particular time frame, and commonly provides information and measurements pertaining to the volume, the worth, and the efficacy of sales transactions. So there are some key sales report terms. First off is sales revenue. This represents the total monetary value generated from sales. It's calculated by multiplying the sales volume by the selling price of each unit. Basically, how many items did you sell and at what price? Sales volume. This is the total quantity or number of units sold during the reporting period. Sales forecast is the estimated future sales based on historical data, market trends, and other relevant factors. Gross sales. This is your total revenue generated from sales before any deductions or expenses are taken into account. Net sales. This is your overall income acquired by a company through its sales endeavors. It's calculated by subtracting returns, discounts, and allowances from your inventory, from your sales. All right, and so that is our second lesson on product planning, mainly dealing with sales and inventory management.